Hello and welcome to our webinar covering the latest federal budget announcements. I'm Lauren Hill, tax partner at Forvis Mazars, and I'll be your host today. Before getting into what the budget announcements mean for you, we would like to acknowledge the traditional custodians of the land on which we meet today. On behalf of Forvis Mazars, we pay our respects to the elders, past and present, and extend this acknowledgement to all Aboriginal and Torres Strait Islander peoples here in respect of their cultural connection to the country. The federal budget handed down on Tuesday the 12th of May announced the most significant set of tax changes in a federal budget in recent years, with substantial structural changes to the way investments and wealth are taxed. The changes for investments are coupled with several measures that are framed as providing favourable tax outcomes for individuals and businesses. While these measures include many welcome changes, their impact will be much more limited than the tax increases for investors. To take us through the detail and unpack the changes announced, we are joined by our tax and superannuation specialists. Susan Kamau, who will talk through tax changes impacting individuals, Evan Beisel, who will provide detail around key tax measures for businesses and family groups, and Michael Jones, who will touch on superannuation and some other tax considerations in the lead up to 30 June. With that said, I'm delighted to introduce you to our first presenter, Susan Kamau. Susan is an Associate Director in Business Services with over 14 years of expertise across compliance, advisory, outsourcing, and taxation. Over to you, Susan, for the detail on how the budget will impact individuals.
Thanks, Lauren, and thanks everyone for joining today. I'll be taking you through the key tax changes affecting individuals from the latest federal budget. I'll focus on what these changes actually mean in practice, particularly around capital gains tax and property investment, and then I'll finish off with some of the smaller but relevant updates. One of the most important changes announced is to capital gains tax. From 1 July 2027, the current 50% discount will be removed and replaced with a system that adjusts the purchase price of an asset for inflation, known as indexation. At the same time, a minimum 30% tax rate will apply to capital gains. In simple terms, instead of automatically reducing your gain by half, the system will now calculate the gain after adjusting for inflation, so you're taxed on the real increase in value. While that sounds reasonable in many cases, it may result in higher tax, particularly for assets that have grown significantly over time. This change applies quite broadly across most investment assets held by individuals, trusts, and partnerships. Next slide. So how does this actually work in practice? If you sell an asset before 1 July 2027, nothing changes. So you still get the current 50% discount. For assets held across the date, so if you sell the asset up until 1 July 2027, you'll still use the current rules, which is a 50% discount. But then any gains after the 1st of July 2027, that you calculated under the new system, which is the indexation method. So effectively, your asset is treated as if it's a reset in value at 1 July 2027. This will be important consideration when thinking about the timing of selling investments. We'll move on to the next slide. The other major change is to negative gearing. From 1 July 2027, negative gearing will be limited to new residential buildings only. So if you invest in a newly built property, you can still offset losses against your income. However, for existing properties purchased after the 12th of May 2026, which was last Tuesday, you won't be able to offset the losses against salary and other income. Those losses can only be used against future rental income and capital gains. Importantly, if you already own property before the 12th of May 2026, you're not affected. So you're still in that negatively gearing rules, which is grandfathered for properties held before the 12th of May 2026. Overall, this is a significant shift and is designed to encourage investment in new housing supplies. Next slide, please. I'll quickly touch on a few other measures. There's some modest tax relief, including a $250 annual tax offset and a $1,000 instant deduction for working Australians. The Medicare levy threshold is increasing, meaning some people may pay less or even pay no levy. And the ban on foreign buyers purchasing existing homes has been extended to 2029. The private health insurance rebate will be simplified, although some people may receive less rebates. And the last one is the pension supplements for recipients outside Australia will continue to receive the pension up to 12 weeks. After 12 weeks, that pension will cease. Overall, these are smaller changes, but still relevant depending on individual circumstances. To summarize, the key takeaway is that we're seeing a clear shift in how property and investment income is taxed. While many of these changes don't take effect immediately, they'll be important to future planning, especially for anyone investing in property or holding long-term assets. As always, the right approach will depend on your individual circumstances, so it's worth reviewing your position early. I'll pass you back to Lauren.
Thanks, Susan. So the key takeaways here are the change in negative gearing and the CGD discount after 1 July 2027, with the benefit of a $250 annual tax offset in 2028. I think it'll be interesting to see how these measures will be implemented. In particular, how the changes for negative gearing will apply where you held the home as your principal place of residence, and then after 1 July 2027, you start to rent it out. So moving forward now into how the budget announcements will impact businesses, investments, and family groups, I'm pleased to introduce tax partner Evan Biesel. Evan leads the Forvis Mazars Tax Consulting Division in Melbourne. He specialises in helping clients navigate the complexities of tax rules to achieve practical and commercial outcomes. Thanks, Evan. Over to you.
Thanks, Lauren, and it's great to be with you today. Well, I'm going to spend the next 15 to 20 minutes talking through some of the measures that matter most to business owners and family groups. And well, there's a lot to digest in this budget. As a big picture, there's two parallel stories. For businesses, targeted, mostly permanent relief. Small business wins, but the changes to the R&D tax incentive hide a narrower base behind a higher headline rate. For family groups, this budget brings the most significant structural change to trust taxation in more than 2 decades. And I can't emphasize that. The end of the bucket company. If you have a discretionary trust, you have planning to do. So I'm going to take you through this in some more detail and also help you think about what you need to plan over the coming couple of years. So starting with some of the measures for business, we've got some measures that are locked in as permanent support. Firstly, the instant asset write-off. This has been a temporary measure going back to 2016 at varying thresholds. That's been extended and extended time again without giving businesses certainty about the tax treatment of future investment decisions. So this is welcome, but it is modest. We are still only talking a $20,000 threshold. Loss carryback. We had this measure for a couple of years coming out of COVID, but it was temporary. Now we get it back as a permanent measure. Companies with less than $1 billion of turnover will be able to get a refund on their tax paid in the prior years. Now, currently, you can only carry forward a loss. Loss carryback means if you had profits in the prior years, but now have a loss, the company can claim a refund for some of the tax it paid in the past. Now, it's still capped by the franking account. So if you've already paid out those profits as franked dividends, you won't be able to get a refund. This will be a cash flow benefit for businesses where it applies, but the franking account cap means it will be limited. The third measure here is refunds of losses for startups. So companies in their first 2 years with less than 10 million of turnover will be able to get a cash refund of their tax losses. But this is capped at the amount of PAYG withholding on wages and FBT that the company has paid. So it's tied to local employment, and it will only work if you have real employees based in Australia. So it rewards genuine local hiring, not a founder and contractor model. So R&D tax incentive reform. The headline here that the government is trying to sell is that this is an increase and an incentive on R&D, but that hides some of the detail. So what goes up? An increase in the R&D tax incentive rate of up to 4.5 percentage points. The intensity threshold for last business comes down 2% to 1.5%. This means more companies will qualify for the higher rate. Additionally, the refundable offset threshold will move from $20 million to $50 million. This is a welcome change that will help businesses in that threshold access cash refunds in relation to the R&D. And finally, there's a lift on the expenditure cap from 150 million to 200 million that will help larger business with big R&D spend. But what comes down, this is critical. Supporting activities will no longer be eligible for the R&D tax incentive. For most claimants, supporting R&D is anything from 1/3 to 2/3 of their claim base. So this is a really meaningful shift. For some businesses who are claiming the R&D tax incentive, any benefit they might get from an increased rate will be completely wiped out by the loss of eligibility for supporting R&D expenditure. So don't just take it on faith. You need to model this in your business. Take your last claim, strip out the supporting expenditure and apply the new rate. That gives you a baseline for your outcome under these new rules. These rules will kick in from 1 July 27, so there's some time to plan. Next is the phase down of the FBT exemption for EVs. Currently, you can get 100% FBT exemption for an EV purchased for less than the luxury car tax threshold of around $90,000. This will stay in place until 31 March 2027, and then a phase down will begin. The first part of the phase down is a 2-year period where only vehicles costing less than $75,000 will qualify for that full EV exemption from FBT. Vehicles between $75,000 and the $90,000 or so luxury car tax threshold will get a 25% discount during that transition period. Then, from 1 April 2029, all EVs will only qualify for a 25% FBT discount. That will be the end of the full FBT exemption for EVs. An important point is the FBT rate is locked in at the start of the arrangement. So particularly for novated leases, when you enter into the novated lease is the time that you get access to the discount available at that time. And that will carry through to the end of the lease, even if that goes beyond 1 April 2029. This means there's opportunities to take advantage of the rules and carry them through for a number of years and get the benefit of the FBT exemption now. Now, I want to stop and let this one breathe for a moment. For the best 12 to 20 years, the standard family group structure for clients with both active or passive income has been a discretionary trust. And commonly, a corporate beneficiary or a bucket company has been a key feature of that structure, allowing an additional beneficiary alongside individuals to receive distributions and pay tax at the company rate. From 1 July 2028, the government proposes 2 things. Firstly, a 30% minimum tax on discretionary trusts. And as part of the design of that minimum tax, we will get double taxation for corporate beneficiaries. This will be the end of the bucket company. This isn't a small tweak. This is the most significant change to family group taxation in the last 20 to 30 years. Almost every group structure will need to be reviewed against the new rules. Let me walk you through how it works in a bit more detail. So the column on the left is how it works today. Trust beneficiaries are taxed on trust distributions at their marginal rates. If the trustee accumulates, it's taxed at 40%, 7%, and that's deliberately penal. It's to encourage trustees to distribute. Distributions to bucket companies are taxed at either 25 or 30%, whichever tax rate applies to the company. The company can then pay out franked dividends and pass the franking credits out to the shareholders, or if the shareholders are trusts, those franking credits are passed out to the individuals as refundable credits. From 1 July 2028, a trustee will pay a 30% minimum tax on all its taxable income, regardless of where it's distributed. This will include capital gains. Individual beneficiaries will get a non-refundable credit, meaning they will pay tax over and above 30% if their marginal rates are higher, but they won't get a refund of that credit if their marginal rate is lower. If the trust gets franking credits from dividends, it applies the franking credits against the trust minimum tax, but does not pass a refundable credit through to the beneficiary. There's some key exclusions: fixed unit trusts, widely held trusts, super funds, deceased estates, charitable and special disability trusts, as well as primary production income. There's also a couple of really niche exemptions I haven't listed here. Let's talk through the bucket company example, because I can't understate the significance of this. The end of the use of a corporate beneficiary in family groups is a significant shift and will require very different decisions about structuring. So here's how it works now on the top row there. The trust earns the income, it pays no tax. A distribution to a company is taxed at either 25 or 30%. The company then can pay franked dividends at some point in the future, and the shareholders can get a refundable offset in terms of the franking credit. From 1 July 2028, here's how we get effective double tax. First, the trust pays income tax at 30%. Secondly, the company is taxed again without credit for the tax paid by the trust. This will mean, depending how the rules are implemented, an effective tax rate of somewhere between 51 to 60%. In reality, it will mean almost nobody will distribute trust income to a company. Then a franked dividend is paid out and taxed as normal. The implication for most family groups: every structure that relies on corporate beneficiaries needs review. And I recommend that those conversations start now, even though there is time with these rules to come in 1 July 2028. But for complex groups, that time will be needed to make the right decisions and work out what is best in each group's circumstances. Now, with these provisions comes rollover relief. The government says it will give a 3-year window to be able to restructure assets out of trusts so that taxpayers are not stuck in structures that don't work under the new rules. In principle, this is welcome, but rollover relief misses several critical issues. Firstly, restructuring can be costly, be it legal costs, advice. And why should business owners and investors who have structured in good faith need to bear the cost of a restructure? Now, the government says the Australian Small Business and Family Enterprise Ombudsman will be available to assist small businesses to understand the options available to them. This sounds good in principle, but generic advice is just not going to cut it in most circumstances. Another critical thing that rollover relief won't deal with is stamp duty. If you have land in a trust and you want to move it, chances are stamp duty will apply. Stamp duty is a state tax. It's not going to be dealt with under rollover relief. And unless you can fit into one of the existing narrow exemptions for stamp duty is going to be a real cost that in many cases will kill a well-planned restructure. So I want to leave you with a bit of a planning calendar so this feels actionable rather than overwhelming. And there's 3 windows I've put these planning steps into. The first is between now and 30 June 26. I want to start by saying nothing is urgent. All the significant measures in the budget have delayed start dates. There is time to pause and plan. However, there's no time to start planning like the present. So map your group structure, identify corporate beneficiaries, understand how the rules will apply to you. The last point for that pre-30 June is if you're setting up a new structure, it's important to consider how these changes will work. There are real opportunities to tweak structuring decisions now that will help once these rules come into effect. Next is the 2026 to 27 income year. That's the time to lock in exempt EV purchases before the threshold tightens on the 1st of April 2027. Secondly, in a family group, you want to model how your bucket company works and start to plan potential restructure pathways. For the CGT discount ending on 1 July 27, next financial year is the time to consider asset moves before those rules kick in. And lastly, for next financial year is to review your R&D claim mix if you're claiming the R&D tax incentive. Understand how the changes in rules will apply to you. Then from 1 July 27, this will be the time to apply rollover relief, if that makes sense in your group. Whilst the 3-year window closes in 2030, a lot of restructures will make sense to action in that first year before the minimum tax on trust distributions kicks in. Additionally, that will be the time to consider other structuring decisions that may not involve moving assets, but contemplate the minimum tax on trust distributions and how that will impact your group. Early planning will be critical, so I'd encourage you to speak to your Forvis Mazars advisor in the next few months, and we'll help you work through the specific implications for your group. All right, back to you, Lauren.
Thanks, Evan. I love that planning calendar. So it seems there will be some tax relief for small businesses. Multinationals haven't gained much from this budget. It seems taxpayers with R&D will be able to start getting a tax refund instead of just that offset. But you'll only be able to start claiming the R&D incentive on those core projects and not on supporting expenditure, as you said. And most importantly, trusts may no longer be as tax effective with that 30% minimum tax and the double taxation for corporate beneficiaries. Ouch. So for our final segment, I would like to introduce our third presenter, Michael Jones. Michael is a tax, superannuation and estate planning advisor, helping businesses and families deal confidently with financial matters. Over to you, Michael.
Great. Thank you, Lauren. Before I start with the superannuation insights, I've just got to pause a moment because it really was an extraordinary budget. Now, here at Forvis Mazars, we service a range of clients, but one of our key constituents are the clients that are the business makers and the clients that engage with their investments in a hand-on way, taking responsibility and being involved. And I've never come across a budget that is more set up to, on one side, provide assistance to people that are earning wages, and on the other side, really dramatically taking away from investors and business builders. the very core clients that we deal with. Now, in particular, just to, I guess, underline what Evan was talking about, I just want to say two things. The changes to the capital gains tax is really significant. It will affect business builders, creative and innovative people in a serious way. Here at a time when innovation is so important, this tax will be an impediment and a burden to those people. The other thing, the end of an era in relation to discretionary trusts. They won't work under these new rules. And that is such a dramatic change. And it's a change aimed at people in private family groups who are engaged with their businesses and investments. So this is a really significant budget for our clients. Segueing from that, if I may, into self-managed super funds. Amongst all these changes for this group of clients, one consequence is that self-managed super funds, superannuation in general, there were no changes affecting superannuation. But self-managed super funds, I think, have now become even more attractive investment vehicle than they were before Tuesday night. It's simply because in a self-managed super fund, you're going to have 10% on capital gains. So 10% tax on capital gains as against a minimum 30% outside super. As far as discretionary trusts and the end of an era, the investment there, I just don't see how that's going to work. Compare that to 10% on the superannuation funds and 50% on the tax of income in a self-managed super fund. I think people will start to think about them more and more. And remember, when you get to the point where your super fund can go into pension mode and your balance is less than 2 million, then you're looking at a nil tax rate. So the attractiveness of self-managed super fund has increased. But also you need to remember that self-managed super funds are not for everybody because of the personal responsibility, the increase in they're audited, the compliance and the regulation is significant. For the right person, though, they're certainly worth it. Can we just go into the next slide, please? So, in a self-managed super fund, you can select your assets and you can have better control over investments. There was talk for a while that limited recourse borrowing arrangements would cease in self-managed super fund, but that never happened. So it's still possible. It really will depend on the circumstances whether that's a good idea or not. And there's also important ways you can structure a self-managed super fund to engage with other entities in terms of investments. I'd also like to point out that it's not widely talked about, but there's ways to structure the control of a self-managed super fund so that if you have multiple generations in a fund, their voting can be controlled and membership can be controlled by, say, a parent. But to emphasise, you don't get any access to the assets until you're retired and over 60 or 65. So that's, I guess, the reason why you get this low tax environment. And of course, they're not for everybody because of the personal responsibility and the compliance and the regulation. But after this budget, I do believe more people need to look at self-managed super funds to see if they're right for them and to understand how in the low tax environment that they provide, we can have a good opportunity for compounding investments over the long period and are well worth considering. Next slide, thank you. And I'll just finish, although this is obviously although there was no changes in the budget, the big change that happened already this year was the introduction of Division 296. So Division 296 applies to members with superannuation balances over $3 million, and it starts on 1 July 2026. Now, I just want to make some points in relation to this important tax. It's complicated. After 3 years of negotiations, we have a fairer tax, but it's complicated. In summary, it's an extra 15% tax on earnings from a super balance that's above 3 million. And it's a further 10% on super balances from the earnings from super balances that are above 10 million. For people who this relates to, and it could be people approaching 3 million as well as people with over 3 million, it's very important to take advice and consider carefully what needs to be done. We do in our firm a lot of analysis in this area, but now the cost of switching assets out of super into another vehicle has to be reconsidered in the sense of this new capital gains tax environment. I'll say one simple thing about this tax. Many people will be better off remaining in super than leaving, but they really need to consider how the death benefits tax will affect them and how that's going to be managed. And for this, if this is relevant for you, then I really encourage you to contact your Forvis Mazars advisor. So that's it from me on super. Short, but still, I think, an important message.
Thanks, Michael. As you've explained, super now seems like a much more friendlier option after this budget and definitely worth considering. That brings us to the end of this webinar. We hope this session has given you a clearer understanding of the federal budget announcements and their potential implications. If you would like to discuss how these measures may affect your personal or business circumstances, please contact your usual Forvis Mazars advisor or one of our specialists. Thank you for joining us.